Now is time for us to talk about balance or lack thereof when it comes to investing with our first full panel of the day. By way of introduction, so hopefully these panelists will start to join me here on the stage. And Andrea Perdomo from Techstars will be moderating this panel. The panelists really include a diverse range of perspectives when it comes to women raising capital. But I will let Andrea take it from here and introduce her panelists.
Amazing, thank you so much. And I feel really inspired with the wolf story. Actually, we had that come up in Colorado too.
Awesome.
And so it was controversial, but I definitely voted to reintroduce them. So we'll see how that goes in a few years. But no, I'm so excited. Thank you all for just this incredible event, and really excited to be just having these transparent conversations. So thank you again to the Fourth Floor team and all the hard work that they've done. So with that, we're gonna jump into, a conversation that I think has been happening a lot over the last few years. But I'm incredibly just inspired by all the women that are about to be able to speak to you. We're taking a bit of a different approach, which is kind of what Breen was saying, something that needs to happen, of how do we really change the ecosystem as a whole. So in this panel, we're going to dive into innovative ways to build a company, investments, funding, and the choices that you have. And more importantly, just because of the event, I want to make sure that we also focus on the importance of creating equitable access to capital. And we're going to talk about what that means, and how we can actually leverage not just the capital that exists, but also really starting to build sustainable businesses to support the scale of underrepresented entrepreneurs so that they can scale their companies, and we can finally create that transformation that needs to happen in the entrepreneurial ecosystem. So with that, I am your moderator. My name is Andrea Perdomo. I work at Techstars. I'm leading all of our diversity, equity, and inclusion initiatives to just support underrepresented entrepreneurs across the ecosystem. And I'm super excited to have 4 incredible panelists that I'll introduce here shortly. We're going to be having really in-depth conversation, just kind of as a housekeeping. If you do have any questions or comments throughout the panel today, please feel free to add that in the chat. I'll be checking that periodically throughout the event. And we also have a Q&A section, so whichever one you prefer, I will be checking both. But we really want to have a transparent and authentic conversation. We're here to really lay it all out and talk about all the hard challenges that we have, particularly as women fundraising in this ecosystem. But there's a lot of hope too that I'm really excited to have these panelists share with you. So with that, we have 4 incredible panelists, and I'm just going to have each of you introduce yourselves. So let's start with Michelle Garcia. You're the partner at Vicente Partners.
Yes, hi, thanks, Andrea. I'm Michelle Garcia. I am a partner and co-founder at Vicente Partners. And before I was at VMP, I spent over a decade in consumer goods and software companies. And I think we're going to talk a little bit about why we do what we do. So for us, we started VMP about a year ago. And so I'm on the entrepreneurial journey myself. And what my partners and I saw was that from our experience working in large corporates, late stage startups, in my case, and investment banking, was that a lot of the truly groundbreaking innovation in consumer goods was happening outside of these spaces and by founders who were willing to really pour their hearts into building companies that were creating and meeting new needs in markets. And so we wanted to use the expertise and skill sets that we had learned in our past experiences in these large companies and in banking, and the networks that we had created to really work with these founders and these companies to fuel their ambitions and to help them meet their goals for the really incredible brands that they're creating.
No, that's great. Thanks, Michelle. And I'm excited to dive into a little bit of some of the M&A experience that you have too, which I think is relevant for this conversation. Sarah, if you would mind introducing yourself, that would be great.
Yeah, absolutely. Thanks for having me. I'm Sarah Abdel-Razek. I'm the co-founder and partner at Riveter Capital. And we are a private equity firm focused on investing in women and minority-owned or led lower middle market businesses. So our mission is really to help close the capital access gap for these underrepresented groups, while also bringing a strategic partnership and the horsepower that many of these companies really need outside of capital to get to that next stage of their life cycle. My background prior to Riveter, I spent over a decade working at various consulting firms. So really partnering with management teams and founders, to help provide financial, operation, and strategic leadership. And so I've had the unique perspective of having worked with founders to really help secure funding and grow businesses, but also now as looking at companies as investment targets.
Awesome, thanks, Sarah. And not to mention too, I think something that stood out when we connected is the what you all do as it relates to like blending just the fundraising and investing in the companies, but also supporting them as they start to hail on the operations side, which I think is fantastic. Dede, would you mind introducing yourself?
Yeah. Hi, I'm Dede Chan. I'm the president and co-founder of FutureProof Retail. So what brought me to my company and business is philosophy. I met my partner in a philosophy club and we bonded over the value of time. So just two things I really care about. One, we want to maximize human potential by removing friction in time. And two, we want to make money by aligning with our values, which directly lead to not only a new business where we are the leading scan and go solution in the market, but we also started a new industry. We're part of the early leaders of the frictionless checkout industry. And we apply what we do in tech the same way we do with our philosophy, which is try to make money and that aligns with our value and save time.
Thanks, Dede. Yeah, and I'm excited to really dive into your own experience as a founder and kind of how you got to today. And Alex, final panelist, if you could unmute and introduce yourself.
Hello. Someone's telling me to change my name, but hi, I'm Alex Batdorf. Get Shit Done. There it goes. Beautiful. Yeah, anything technical, don't make me do it. So I'm Alex Batdorf. I'm the founder and CEO of Get Shit Done. I'm a 3-time entrepreneur. I have been self-funded. I have been VC backed. And now I'm crazy person focusing on creating more equitable outcomes for female entrepreneurs by getting them focused on traction. Why? Because I spent so much of my last company hearing this narrative about how hard it is for female entrepreneurs. And usually the savior is a VC. But that's not really the systemic barrier for women. Get Shit Done, one of our mottos is fuck 4%, meaning that women entrepreneurs make up nearly 50% of entrepreneurs. Our companies currently only bring in 4% of total business revenues. Nothing else matters until we fix that. That check will not save you. So at Get Shit Done, we really focus on getting our founders focused and our tribe focused on that traction piece, moving through the pipeline to gain more revenue and to create more equitable outcomes so we can bridge that wealth gap with our companies. So yeah, that's about me.
Yeah, thanks, Alex. And I'm super excited to dive into that, right? Hopefully give some founders some advice on how to do that. So let's just jump right in. I have a few questions that we've prepared. So I'm happy, I will go through all of them, but ideally I would love for the audience to really get engaged in this conversation. If you are a founder and you have questions, you have 4 incredible panelists. I'm a founder as well, so I can put my founder hat on and help support. But this is an incredible opportunity, especially during the times that we have going on right now. It's a virtual experience, but it allows you to actually connect with these panelists and ask questions. It can be about, anything related to the topic about fundraising and maybe even some challenges that you're having. So I'll leave it with that. There is a chat. I think we're all zoomed out, meaning we know how to use it. So, but please add questions and comments throughout the conversation. I think it'll just make it much better. But again, I have a lot of questions to get us through the next hour, but would love to hear from you. So let's just jump right in. So this question is for Alex and Sarah. I think, I just want to kind of start by setting the groundwork a little bit for the audience as far as what do we mean when we talk about different stages of companies. I know this is something that comes up. We talk about early stage, idea stage, growth stage. How would you describe the difference for a company that's in an idea stage versus growth and scale? And how can founders really start to think about, knowing what stage that they're in? Because I think that alone can help realize what funding opportunities exist. So I'll open that up to Alex, maybe if you want to jump into that one first.
Yeah, I think the tough thing here is that we conflate stages of companies with raising capital. And I think that's a very vicious narrative that we've gone down, and it's toxic because we have a lot of founders out there who are building scalable. And let's take a step back. Scale is not synonymous with VC. VC is very new. VC started in the 60s. People were scaling businesses before VC. So let's just be straight on that. The second thing here is that what I hear often from founders when they're coming, especially women entrepreneurs, is we conflate needing like revenue or something in our revenue in our businesses with needing capital from investors. Investor capital is not meant to start a fire. That's all the founder. Like if someone comes to me, a founder comes to me and they're like, hey, I need X, amount of dollars to get this thing going. And I'm like, no institutional investor wants to put their capital there because they're meant to be an accelerant. And so when we look at stages of a company, it gets conflated when we look at early stage, growth stage, because it's very isolated right now to raising capital, which of the people tuning in, if you're a female founder, 1 out of 10 of you will actually raise VC, but that doesn't mean you can't scale. And so early stage can mean, I've seen it from the spectrum, from pre-seed to someone who's raised X amount of capital to someone who has revenue, like millions of dollars in revenue. It really depends. I think that matters less than what is actually happening in your company. Are you generating revenue? Are you seeing a demand for your product? Versus looking at just, the opportunity for capital, because the end of the day, most entrepreneurs, this is not even a woman thing. I think most people know the 2% stat, but that's 2% going to less than 1% of all founders. So within the context, it's not accessible. So the stages are weird, and I feel like it's not as important. But if you actually want like the fundamental breakdown from a funding perspective, it's usually early stage or pre-seed stage is like, you just are getting started, might have a wait list users. Then if you look into early stage is now becoming seed. This is different from when I was raising, to like later stage or scale stage is like Series A or whatever. But I don't feel like that's more as important as what's happening in your business right now and trying to put it into a bucket. Do you actually have a business that's viable that people want to buy or buy things from or use the service? That's way more important than the stage.
Yeah, Alex, and I think you hit on something that's really crucial, which is this narrative, right? This narrative that, it really has kind of evolved into, at least from a societal perception, like the only narrative. And so it's really interesting because when we talk about funding, it does always come up as like, what stage are you in? And to your point, what traction do you have should really be the question that's being asked.
What money are you making? It's a business.
Yeah.
That should be the first conversation, period, versus how much money are you raising? Do you have a business? Let's talk about that first.
Yeah, I think that's great. Sarah, I'd love your thoughts on this too. I know, and from talking to investors, like there are certain stage companies that are funded by certain investors and not, but I'd love your thoughts on this and how we can kind of level set when we get into some of our other conversations.
Yeah, I think what Alex said is exactly right. Is outside of thinking through what stage of funding you're at, think about the stage of the life cycle of a company, right? So at a very high level, you have idea/validation phase, which is you have a good idea, you put together a business plan, you thought through the market and competitor analysis, and you started product development. At this stage, you're probably not raising institutional capital. You're bootstrapping it, you're talking to friends and family for small pockets of capital. And then growth stage is really you've proved the concept, you've proved the business model, you know, you need some level of capital for marketing, hiring a small team to fund working capital needs. And generally that's when you can start thinking about, you know, seed investors. And then scale is really all about monetization, expansion, building up the team more, spending more on marketing to start capturing that market share. And so I would think about it in terms of where you are and what you've proven and the traction you've made from business standpoint. And based on that, you can identify, one, if you need capital or not, or just need strategic partnerships and mentors to help you think through how to get to that next level. And if you do need capital, it helps you understand who the right people to go to are so that you have the, you know, best shot at securing that financing.
Yeah, thanks, Sarah. I think that makes a ton of sense. And we'll kind of continue to talk about that, but let's continue to build the foundation, right, as to why we're all here today. The reality is that there are challenges, right? Like Alex just said, the percentage of VC funding that goes to women it's laughable. It's not a lot. It's also not the only capital that exists, which I think is something really important that I want our audience to get out of this conversation. But let's level. What are some of the challenges and inequalities when it comes to women raising money and scaling companies? Like from your experience, and this question will be for Michelle and Dede, and any of the other panelists can jump in as well. What are some of those barriers that exist? I think most of them we're aware of, but I'd love your thoughts on that. Michelle, if you want to go first.
Yes, sure. Yeah, I think this is a really well documented issue, and it's something that we have been trying to tackle for a long time. You know, it's very well known, like women receive less funding dollars. Many times the companies that are funded that are led by women are frankly more successful and more sustainable, but yet still there's a huge market inefficiency. And I think that, you know, I think that there's been a lot of kind of inward looking in terms of what can we do differently as women in terms of how we promote ourselves or, you know, how we act as leaders, et cetera. But to me, this is really a holistic issue that is across the spectrum, not just on fundraising, but also the roles that positions of power that women have in corporate America, in financial institutions, even in government, which we're now seeing progress on, et cetera. And, you know, to me, it comes down to kind of tackling all those things holistically, which I think is it's great that the fourth floor has put these panels together in this way, because I think it does cover a lot of topics. For me, you know, access to networks is a huge thing, and not just women networks, but, you know, networks for financial investors, for finding your team and your co-founders, for your operating partners, et cetera. But from my experience, you know, in helping with fundraising or even starting a company myself, it's seeing women on the other side of the table, making the funding decisions. In consumer goods where I work, it's seeing women on the other side of the table, seeing what's the market and defining that there's a market need, because some of our needs are different from, you know, the traditional investors or the men in the room. And then from an exit perspective, it's women in the boardroom making the decisions of which companies to buy, which companies have potential, leading the brands and being the CEOs of the companies that are defining that strategy. So I think, you know, lots of challenges, but we're doing a lot by getting more women in the room and more women around the table, and not being the only one in the room anymore.
And we will talk about how to overcome those challenges here in a second. Dede, if you don't mind jumping in, that would be great.
Yeah, I love this question. And I think absolutely, besides the opportunity discrepancies, there's another big issue, which is the communication and the framing of these opportunities. I think a lot of women have challenges because woman entrepreneur started her own business because she sees the systematic issue, or she sees a product that she want to improve on, or a service she want to improve on. So she kind of started her own business to be her own boss. But when it comes to funding, we have two parallel narratives. On one hand, we have, what is she doing? What is this business? Is it good? Like Alex mentioned. And on the other hand, we have the fundraising model, which is kind of a cookie cutter model that we try to pigeonhole everyone in, which talk about stages, which have a lot of jargons about, and and they expect every company to be a unicorn, and you have to have 10x return and all of this. So everybody's financial model, once you start learning and you start hiring like consultants, or you hire people who knows what they're doing, but they don't know you or your business, teaching you how to present your business, everybody start to sound the same, and everybody have the same financial projection. That's not real. That's not true. That's just has not became reality. But everybody is a 10x company. Everybody is a unicorn company. So we started to participate in a conversation that is not part of the actual reality, but part of this financial narrative that we're new at communicating and navigating. And part of this reinforces a hierarchy that the investor and the founders are completely separate, instead of there are two people coming together as partners working on a new venture together. So one of the things that Force4 is doing really well is we're bringing founders and funders on the same table today. And one of the new things that's come into the market very recently is they have like crowd equity fundraising, like Republics, WeFounders, some of these companies that kind of democratize fundraising access. And I tell all of founders, we should think about money into how we make money. And if we have to raise money, we should be investors today, even if you're a micro investor. You should go on one of those crowd equity sites, sign up. You can invest for as little as $100 and see how you pick the company. And by doing that, you would learn everything. You would learn, one, this diversity in how people pick and why, this emotional and this business model. And you would learn how to present your company a lot better by putting on your investor hats. Because there's a lot of time we focus on investors that has founder hats, but we don't look at founders being on the same table as the investors. And I think the best businesses are partnerships where investors and founders are partners together in creating a better product, a better service that serves greater value.
No, thanks, Dede. And I think you brought up a lot of, really great points, and that's kind of changing the landscape of what an investor and founder relationship looks like, which is really crucial. There's a lot of questions coming in, which is fantastic. So I definitely want to get to them. But kind of, on that point, I think, like we just talked about, there are, transparently, there are a lot of barriers, challenges that exist for women entrepreneurs. But over the span of, at least when I started my company in 2015 to today, I've seen a lot of progress. There are way more women at the table and at events, and as investors, drastically different from what it looked like even 6-7 years ago. But I am curious, that's progress. We still have a long way to go, but we are at an inflection point right now. And, this question is kind of for everybody on the panel. What are some shifts that you are seeing and some value added? And I think Dede already alluded to some of this, of alternative funding platforms that exist, but I'm curious, and I'll open that up to the entire panel. What are some of those shifts that you're seeing, and what does the future really look like for this space?
I can jump in. I think what I'm the most excited to see, and it's not as quick as the funding conversation, but I think optionality needs to be the focal point for any entrepreneur, because we are driving so many founders. I think Dede mentioned this of, here's one path to scale. Again, scale is not synonymous with VC. There are so many entrepreneurs I know that, and every entrepreneur, you start out saying, this is the impact I want to make in the world. This is the North Star we have. And what we're skipping over, and this happens very often in the entrepreneurial ecosystem, is we jump from, I am going and I'm building this type of company, I'm scaling, to, okay, how do I get the money to do it? Versus saying, well, why do I need to go down that road? And what's in alignment with our North Star? That is so often missed. We talk so much about how to raise VC. That doesn't fucking matter until you understand if that's the right vehicle for your business. I have done self-funding. I have been VC backed. VC money is not appropriate for the majority of businesses. VCs will tell you that, but for some reason, the Inc. magazines and the entrepreneur magazines of the world get in your head because we are glamorizing a dollars raised versus celebrating the companies that are doing well. So I would say at the end of the day, the first thing to really ask yourself, and what I'm excited about seeing is women really getting in alignment with this, is saying, where do I ultimately want to take this company? And what are the best vehicles and partners that are going to help me get there? And understanding with each of those partnerships, what's the expectation and responsibilities of making that happen? What people don't know, and I say this very often, I'm like, most people are not about that VC life. And here's why. Is because at the end of the day, the expectation is once you sign on the dotted line, you have a fiduciary responsibility to your partner now. They are not just giving you a check. They are partners in your business and they have a say. And that means when a VC says, we're in this for the long haul, it's 10 years max. And really 5 to 7 years, I want to see some type of exit, whether it's an IPO or if it's acquisition. Now, what they also want to see is at least 10 to 30 times their money back. Now, really ask yourself, am I about that life? Is this in alignment, that way of scaling in alignment with this type of company and how we operate? We've seen many companies crash and burn because it wasn't. Nasty Gal is a great example of it. And then not only ask yourself, is it the right vehicle for this business? And is this business constructed in a way that can sustain that? And the second thing is, even if it is, that first question takes most people out. That takes most founders out because it's usually not a suitable vehicle. VC can be really, really amazing if it's the right type of company. Now, the second thing you ask yourself, even if it is in alignment with the type of structure of the company, is ask yourself, is this really in alignment with the impact I want to make? Can we do it in 5 to 7 years? Do I want to still be running it? Because those things start to get muddled and you might not be there. Because again, you have a fiduciary responsibility to your shareholders now. It doesn't matter about you continuing to run it as the founder or the CEO. It's about getting that return to your investors and their investors, which are their LPs. We skip over that and we send all these women down that rabbit hole. And most of them, and this is not even a woman thing, most founders should not be raising institutional capital. The second thing is that if they are, it's not in alignment with a lot of their visions. So I would say before we talk about how and what I'm excited about seeing in this space and more women getting privy to is really saying, you know what, is this really what I want and in alignment with what I want to create and put out in this world? And seeing that shift happen. I can even see on our podcast alone, we interview so many different women who have scaled successfully, but not just with funding. And look at those different models so you can get clear. Like Fawn Weaver, founder of Uncle Nearest, the fastest growing whiskey brand in the United States, Black female founder, raised $60 million from all individual investors. And she's building a legacy brand. She was like, I know I clockwork 3 years. Most of the people I know that have raised VC got ousted because if they didn't hit expectations of their LPs or their investors for their LPs, that's very standard. She was like, I know that I want to continue running this company. And I know everybody on my cap table, when they want to exit and when I want to be the one that buys them out, and I'll be the one to do it. That's one way of doing it. Tiffany Aliche, the Budgetnista, she has built a $10 million company, owns 100% of it. And she did it just like by building this amazing well-oiled machine. So I'm excited for seeing more women looking at the different streams of how you can scale instead of just saying, this is my only option. And going back to what Dede said earlier, is that we love saying, well, we're $1 billion company that can do 10X. Don't try to make yourself fit into a narrative. Think about what narrative fits best for your business. That's what I'm most excited about seeing is women really embracing optionality for their businesses.
Yeah, Alex, and I love that, right? It's like the optionality that there are a lot of different paths that you can take as an entrepreneur. And it does also depend on you as a person, right? Like what kind of, like what you just said, what kind of life do you want to lead and live for yourself? Because those different paths mean very different things. Does anyone else want to jump in on that? I think that's a really, really great segue. And then there's a ton of questions coming in through chat. So I want to get through those too.
Yeah, just to add really briefly to what Alex was saying, I mean, let's say from the exit perspective, just from my experience working on deals acquired by strategics, et cetera, which is one path, right? That maybe isn't right for everyone, but which is one exit path. I just really echo that. I mean, so many of the deals are not VC backed companies, right? If I think about all the deals that I've done, so many of them are companies that really built really sustainable brands that really resonated with consumers over the course of 20, 25 years. And some of those were bootstrapped, some of them were friends and family, some of them were credit lines, et cetera. So I think, Alex, just to echo what you're saying, I mean, optionality is key and really understanding what you want. And VC is not the only way, it's one tool.
Yeah, that's great. So there's lots of questions coming in. I'll start with Debbie. And this is a bit of a broad question, but would love all of your perspective on it. And it's what is the, switching gears to women founders, right? And women entrepreneurs, what's the biggest mistake that you've seen founders make? And it could be a little bit of what you were just saying, Alex, of kind of trying to pigeonhole yourself into one narrative. But is there anything outside of that you've seen from talking to women founders that maybe for those listening, don't make this mistake, right? I always say, don't make my mistakes, make your own. But any advice that you'd want to give to founders?
Yeah, I have many, but I would love to hear from, because I'm a founder myself, so this is 3 times for me. I would love to hear from other folks, and I'm happy to chime in as well after.
I'll start. I think when you start as a woman founder, there are tons of people. I like the analogy. You're like a tiny fish in the pond, and there's tons of shark that's like, oh, she's inexperienced, she's new, she's insecure. I think there is that idea that women are insecure. And, to be honest, when you start out, there's a lot of internal insecurities. So the biggest mistake I think a lot of us make, or I made, is we end up paying a lot of people to tell us and keep us insecure. So in the earliest stages, you end up probably paying for, really fancy, big title companies you are not needed. You don't even have revenue yet. You just at the idea stage. You don't need the biggest bank. You don't need the biggest accountant. You don't need marketing. You don't have a product in the market yet. So you don't need to pay for marketing. That is silly. Or you pay for a big, really prestigious, like when you go to advisors, they might say you have to pay for someone who's like a hot shot in the industry. Who's typically a hot shot that's very white and very with a big resume. But the hot shot in the industry might not be a hot shot for your startup, for your company. They might be a super salesperson with a ridiculous salary because they have an entire team behind them that's doing all of the heavy lifting. So when you start a company, you are most important. And I think a lot of the time we made the mistake by minimizing ourselves and seeing without you, your company fail in the earliest stage. You have to take care of your mental health, your physical health, and you have to keep your confidence, and you don't have to pay for other people to tell you you're not good enough. Because sometimes when they can't help you make money, they keep you insecure, so you don't know, so you pay them more, so you go out of business faster, so you need more money than you actually do to make that business. So I would say spend the money on you, spend the money on your healthcare, spend the money on making you the best version you can be, work out your insecurities, wherever that's get in the way, like open up the path so that you can be the best you can be, and then you can make money. And you have the answers because you are the boss, like be the boss.
I love that so much. That just so resonated with me. Where were you six years ago when I was starting my company? Any other thoughts on that? Like, what have you heard from founders or that you just would like to give them advice on? And then I'll move on to the next question.
Yeah, I'll jump in here really quickly. I think from my perspective, I'm a founder of an investment firm, so it's really different than starting a business that has products or a service that you're providing to customers. But I think one of the things that my co-founder and I really focused on early on is really agreeing on what our thesis was going to be, what we were trying to do, and how we were going to do it. And as we started talking to potential investors that were going to invest with us, some people will pull you in different directions. And I think being grounded and aligned in exactly what your values and your mission is really important, because as you start having discussions with people that you perceive as much more sophisticated than you or have way more experience than you, they tend to pull you in directions that you might sort of follow. And so just having clarity into what exactly you're trying to build and the values and how you're going to do it, I think is really important. And just sticking to that and, staying true to what you're trying to build.
Yeah, thanks, Sarah. And I think that's a little bit kind of also tied to clearly the investment side, right? Of like, what are your own values, the values for your company? What are the expectations? Like, really look at the vision that you want. And I think that actually is a good segue into this question, which is, do you think that brands with a social impact mission and good traction can successfully raise money in the global market today? And that's a question from Joanne. And I think the emphasis here being on the social impact and mission side. Alex, I saw you unmute, or Sarah.
Yes. I would say the majority, so the Get Shit Done tribe, we're a 50-50 split. So we're a 50-50 split of, 50% of our founders are VC backable, meaning that they have raised capital or about to. The other 50% will not, should not, and they have no desire to. What they're all doing is building scalable. And so when it comes to the social impact, what we keep noticing more and more of is inherently a lot of women's businesses have some sort of, because it's our nature is to be nurturers. And so even if you're like, it's an apparel business, like one of our past demo day winners was Kahendo, and Kahendo is a fashion line. It's her namesake brand. And she started her pitch and she crushed it because she was talking about like how the roots of her like native land in Congo and how she's trying to create these jobs out there. But you would think just a fashion line, right? A good example of this from a VC side, if you want to, think of that in terms of the scale side and getting funding. Nasa Mishler from Avarice Effect is hands down like a good example of this. She just closed out a round of capital too. I mean, when they got into our accelerator, I mean, they were looking at increasing their traction so they can really create more of that momentum with investors. I mean, in the accelerator and beyond, she ended up she increased her users by 222%. She ended up closing capital from investors, both on the institutional side and angels. And she is a disaster relief platform. So they are inherently social impact. They basically look at, in a disaster, whether it's a hurricane or earthquake, 60% of goods that are donated are actually useless. And so they become that bridge. And so they created amazing partnerships with the Walmarts, the TaskRabbits of the world, and so on and so forth. And they started expanding into like NYC public schools and things like that. And so I give those examples because it is harder to see. And I think this goes back to that narrative again of how companies are positioning themselves to be appealing to investors, is they think, well, we're going to be a unicorn, we're going to be a billion, multi-billion, But at the end of the day, like, investors are still human and they're not very rational all the time when they make decisions. Of course, they want to see the ROI, but they still want it, like, for many of them, they're making a decision based on what they care about. And a lot of them do care about social impact and issues, especially I see that more, not everyone, but a lot of women investors. So absolutely, you can scale social impact. Absolutely. It's just how founders are constructing the narrative and how they want to be perceived, because this ecosystem makes us wrong if we want to do good and make money and say, you can't do both at the same time. I'm a very conscious capitalist. So I truly believe you can make a lot of money and do well for everybody.
Yeah, I think it's so true. We hear that all the time. I know you can't do both, but you can, right? That we've been seeing it. It's a proven model. I'm so tired of hearing that personally.
This is a great example.
Yeah, exactly. Sarah, I saw you unmute if you want to comment on that.
Yeah, just to add to that, I think right now there's a lot of awareness and people are being really thoughtful around carving out dollars specifically for ESG, specifically for women, specifically for minorities. And so I think there is an opportunity for founders to access these set-asides. But with that said, it's important to make sure, again, that you are at the right stage, that you're being thoughtful about where you are and how investable you are, but definitely take advantage of that. I think there's a lot of LPs and a lot of firms that are carving out dollars specifically to focus on that. And I think another important part is making sure that you're measuring your impact and how you're going to communicate that to the investors, because there's a lot of companies that have a mission to be sustainable, but how are you tracking that, or how is it measurable? Because that's going to be really important for those specific investors that want to put their dollars to work in this space.
Thanks. And Michelle, any final thoughts on that? I know I saw you on mute too. So.
Yeah, just quickly, I mean, completely agree with everything that Alex and Sarah have said. From the, I guess, consumer brands perspective, and just to broaden that a bit, I mean, what we're seeing in the spaces that we play in is that everyone, whether we're talking about companies or investors, et cetera, or consumers, frankly, they're looking for, you know, businesses that are, quote, doing good, that we feel good being a part of. And so everyone's looking for brands that are thinking creatively about how to be more sustainable, how to have more of a circular supply chain, how to promote healthy eating or wellness. And so I think that it's social impact is huge, but it's also thinking more broadly about that too. And I think it's frankly a little bit hard to be a brand right now that doesn't have a really authentic voice and isn't trying to promote wellness and sustainability.
Yeah, I think, no, that's great. And yeah, conscious capital is compassionate. It's kind of, it's cool right now. So as it should be, it should have been a long time ago. So here's another question. And I think this is, I'll just let whoever chime in on this. This question's from Kristen. How do you close a deal? So assuming that we're going the, closing around, she says she has a lot of investor interest, but how do you get a lead investor to finalize a seed round? Any advice?
From a founder perspective or from an investor perspective?
This is from a founder. So it sounds like founder has a lot of investor interest, but not quite the lead investor for a seed round.
Got it. I can say my experience with that. Depending on how long you've been raising, it is all relationship building. I think someone said that it's like investors invest in people, not your ideas. Ideas are really cheap. I would say the thing that really helped, us move to getting more interest, and I've talked to every female founder that I've talked to as well, when we got the checks or we started like closing easier, is when we were simultaneously focused on traction. And we also, I think it's two things. We had traction because, as you're experiencing right now, fundraising is a full-time job on top of your full-time job, and God bless mothers, because that's another full-time job. So that's the one thing there is it's the relationship building, but also realizing that, when it comes to closing that investor, it's the traction piece, saying that we still see demand going up. The other thing that from a fundamental psychology shift that really helped was when we shift from being in survival mode to opportunity mode. Mind you, this is my friend Rachel Rinnock, she's the founder of Wethos, does this very well. And she came to talk to our founder. She was like, look, I have to put on a face when I go into meetings. She was like, mind you, maybe an hour before I was on the floor in my apartment with anxiety, almost crying. But when I got into that meeting, I had to show up the way I showed up. And she has BVE, which I call big vagina energy. I think every founder, when you're going into these conversations, especially female founders, is you need to activate your BVE. I remember we had a 4-week runway, and I couldn't be in survival mode. Hey, I need this check, because that's in a relationship. If you have someone who's desperate, you're oh, I don't think I want you, right? With investors, it's the same thing. We had to say, look, we have this going on in the pipeline. This is what's happening with this capital. This is what we're going to do next. Are you in or out? You don't want to miss this train. And with investors, at least on my end, and what I saw, and then I did a little bit of time at a family fund right after my last company, is that investors love FOMO. They really do. It's kind of I especially male investors, I always say it's kind of like that fuckboy sometimes, where the foot's in the door and I want to see until you get really, really hot, and then I want to come in. Not all investors are like that, but you have to present that we're hot, like, and we don't need you, right? It's like negotiation. So I would say it's two things that I've seen as a founder on my end. When we closed checks, it was keep traction going up. And so it doesn't look like we're just going to put money in and we're not really sure where it's going to come out. And then the second thing is shifting your mindset to you are not asking for a check, you are presenting an opportunity.
Yeah, FOMO. I think that's and the relationship analogy, as weird as it is, it's so true. So we do have about 5 minutes left. Any other quick thoughts from the panel? And then I'll have one last question for everyone.
I'll just quickly add, so a lot of time when it comes to negotiation, closing, I would say use plain language and figure out the terms. This has helped me with fundraising as well as like business deals. Like I put in Excel, here's the economic terms, here's the control terms. What do you want? What do I want? What can we negotiate with? And then once you figure out the terms you want and put a timeline on, like schedule. So, okay, what else is in the way? What do we need? Like you really push for the timeline. Anything else? Great, we can close the deal. Then you give it to the lawyers to help like legalize all of it. But like make sure you understand the business term. And it's just simple. This is how much I'm giving you for this much. And these are the control. And this is how we work together. If you can put that in like plain language and like into checkboxes, I think it would make closing like deals with clients and investors much quicker.
Yeah, and for the lead one too, right? It's having that conversation of, hey, I have three investors are already here. Like, do you want to be a part of it or not? And having those really transparent conversations.
What does an investor think? What are y'all's feelings about that? Spill the tea.
I think that makes a lot of sense. You know, we focus on investing in smaller businesses. They're generally a bit more mature than early stage. So there's sort of proven business model, stable performance. But what we found working with founders, a lot, obviously mostly women and minority, is exactly that. Before we legalize things into these agreements that nobody can understand, is just plain Excel, lay out the terms and negotiate that way. And we found that just for everybody, it's so much simpler to just talk with facts and data in a simple manner, and then we can memorialize it. The attorneys can work on that. And so that has worked really well with us, just given that primarily we're investing in founder-led and owned businesses, to try and connect with the founders at that level and build the relationship directly, and leaving the legal jargon to the side.
Yeah, I think that's helpful. Thanks, Sarah. So 2 minutes left, lots of amens, lots of love this panel. I think I'll leave with one final question that had just kind of come up here. And it's really, you know, if we kind of transition to like, if you take anything away from this is that you have options. And I think something that came up in the chat is, how do I present my traction? What are some examples of not only things that I should be measuring, but to be able to say, hey, like, here's my track record. Any final thoughts on that? On just, you know, is it potential customers? Is it followers? Is it subscribers? Like, what are some of those examples of metrics that founders can use to prove that?
Feedback. I think one of the things that made us the industry leader, we're the only company that take feedback from our user, which everybody should. In today's date, if you're doing direct to consumer, or if you're doing B2B, like part of the traction that will help you improve your business, service, and product, as well as help tell you where you need to go, is to get the feedback from your end user and to see what they are. They're going to help you save a lot of time, and they're going to pay for your service. So I think, you know, before you have, you know, besides the normal attractions of revenue, of like pipeline, like customer feedback is a traction that's often missed that can be extremely, extremely valuable.
Yeah, that's great, Dede. Alex? Me?
I would say you can approach this two sides. So the first is, I think any founder needs to do, which we have our founders do, and we'll have this public. We just launched the announcement for our Superpower Scaling School, but then there's like a free course there where it breaks down the frameworks we do with our founders to get them hyper focused on traction. And the first thing is like understanding your North Star needs to always be at the forefront. Be clear about that, because the moment a founder forgets that is you make a lot of missteps. Like the folks like the WeWorks or the Wings, the founders there, like they made a lot of missteps, but they were out of alignment with the ultimate vision they really had, which was good intentionally, you know? Then break it down to like, what are your goals, quarterly goals? The most important thing is you need to understand how you're going to get over this mountain to get to the next, which is how are we going to get to the end of 2021? And then understanding of all the traction channels you're doing, like you can't improve what you're not measuring. So like attributing, if you all are doing email marketing, if you're doing social, if you're doing whatever, what is really important is not just saying, hey, we're going to do these activities. It's saying, hey, how do we measure success and what does success look like? What do we expect from that channel? Otherwise, why are we participating in this channel? And that's where I see founders doing shiny object, because they're not getting very clear on this is why we're doing it and what we expect for this to return. And so if you don't see the return, it's easier for you to optimize and transition. And so not only saying, here's our goals for the year, but also saying of the activities we're doing in the company that are supposed to get us there, what are we attributing, whether it's you're measuring in users or revenue, you need to be able to break all of those down so you can see how it all adds up, because you can see whether you are in a good position or you actually need to fill a gap. The other side, from a funding perspective, the best thing that helped me to understand traction expectations. And I really hope any, you know, probably the VCs or the investors on this panel are doing this, hopefully you are, or any in the audience, is sitting down with founders and telling them, like not being vague and just saying, hey, like, it's too early. What does too early mean? There's so many founders that are literally spinning their wheels because they're like, why isn't anyone telling me what's happening? Like, take that moment to really help them, because they could still be a good opportunity for you. Sonia, I'm going to call her out, Sonia Nagar. She was formerly at Pritzker Group, freaking amazing. First investor when I was in my last company raising, sat me and my former co-founder down and said, here's what's happening in your industry and the metrics we typically invest at. That gave us a compass and put our team to work to say, here's what we're shooting for if we want to get that check. I think to fill the gap there, because so many entrepreneurs are literally spinning and they're like, I just heard I was too early. Like, I really encourage any investors to sit down with founders and tell them what it looks like. I know that it varies across different funds, but it gives them a gauge so then they can actually try to see if they can hit it, because it could still be a good opportunity for you.
No, I think that's great, and a great place to end the panel, which is with some tangible advice for both investors and founders that are here. Thank you all so much. Thank you, the fourth floor, for allowing us the time and space to have this conversation. Really enjoyable. I don't think it's the end of the conversation. There's a lot of great conversations that need to continue. But again, like, feel free to reach out, connect with any of us. And yeah, thanks again. And thanks to all the panelists. This was fun.
Yes, huge thank you. Thank you so much, Andrea. Just excellent job moderating, and all of you were wonderful. This was just a fantastic conversation. So thank you so much.